Ever wondered how a software company records its annual subscription sales? Or how a construction company accounts for the materials it purchases for a project? Today, we're breaking down some key accounting concepts and illustrating them with real-life examples to help you better understand the world of accounting. First up is the principle of revenue recognition. Picture a software company that sells yearly subscriptions. The revenue recognition principle dictates that revenue should be recognized when it is earned, not necessarily when cash changes hands. So, when this company sells a subscription, it acknowledges a portion of the revenue each month over the subscription period, reflecting the part of the service that has been provided. Next, we have the matching principle. Imagine a construction company buying materials for a building project. The matching principle states that expenses should be recorded in the same period as the revenue they help generate. So, the construction company would record the cost of materials as expenses. In the same period, it records the revenue from the completed project, not when the materials are purchased. Now, let's delve into cash versus accrual accounting. Picture a landscaping business mowing lawns in June but only receiving payment in July. In cash accounting, the revenue would be recorded in July when the cash is collected. But in accrual accounting, the revenue is recognized in June when the service is delivered, regardless of when payment is received. Another important concept is depreciation. Imagine a company buying a delivery truck for $50,000 with an expected useful life of 5 years. According to the concept of depreciation, the cost of the truck should be spread out over its useful life. So using straight-line depreciation, the company would record $10,000 in depreciation expense each year for 5 years. Next up is inventory valuation. Consider a retail store with clothing inventory. The store can use different methods to value its inventory, such as FIFO, first in, first out, or LIFO, last in, first out. FIFO assumes the oldest inventory items are sold first, while LIFO assumes the newest are sold first. This choice can affect the reported value of inventory, the cost of goods sold, and net income. Lastly, double-entry bookkeeping. Every time a business makes a transaction, it affects at least 2 accounts in the accounting records. For example, when a company sells goods for cash, it increases its cash account and decreases its inventory account to reflect the sale. By understanding these concepts and seeing how they apply in real-life scenarios, you can gain a stronger grasp of accounting principles and how they're used in various situations.